they looked at many different ways that you could possibly rank companies beyond market capitalization. So, the dividend yield or the sales or anything. And they said, actually, market cap is one of the worst ways to do it. Hello, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Tom Stevenson, Investment Director here at Fidelity, to talk about one of the biggest trends in investing over the past 20 years or so. Passive investing or index investing is now how half of us do our investing. But, and this is the question we're going to be asking today, are we doing it wrong? Is there a better way to invest passively? First of all, Tom, welcome along. How are you?
Good, thank you.
Passive investing. Let's start with the basics here. What is it? And what is it an alternative to?
Yes, so passive investing is, as the name suggests, an alternative to active investing. So just to explain those terms a bit, passive investing essentially doesn't make any choices, it doesn't make any decisions. All it attempts to do is to mimic the performance of a stock market index. So, for example, the S&P 500 or the FTSE 100. And in order to do that, it in its simplest form, it simply buys all of the shares within that index. Therefore doesn't make any decisions about which ones are good or which ones are bad. It just simply buys the lot. Yeah. An active investment approach is different. The job there for the fund manager is to choose the investments that they think are going to perform the best in the future. And they create their portfolio on that basis. So they may hold a lot of one stock and none of another, if they decide that one's a good one and the other one is a bad one.
Yeah, and the traditional approach to passive investing is that you buy companies in an index in the proportions that they make up that index, right? And that is by, well, we'll call it market capitalization, awful bit of jargon. It means size, doesn't it? It means value, a cash, monetary value of a company. So you add up all the value of all the companies in the index and you buy shares in every one of them in the proportion that that company makes up the index, right?
Yeah, absolutely. So I said there about the active fund manager choosing they might buy more of one stock and less of another, but that's a choice. Yeah. With a passive fund, they're actually also doing that. They're buying more of one stock than another, but they're doing it in a purely mechanical way on the basis, as you suggest, on the basis of the size of that company. That's why it's called, in the jargon, a capitalization weighted index. So the balance of holdings within the passive fund is determined by the market capitalization, aka the size of the company.
And that's why you'll hear in conversation, people will say, Barclays takes up 4% of the FTSE 100, or Apple takes up 5% of the S&P 500. Those are indices. And there are investments that track those indices passively, and they'll buy it in those kind of proportions.
Yeah, that's right. So, as you say, to take the S&P 500 example, Apple it's actually about 6.7% of the S&P 500 index, which, when you think, about the total size of the S&P 500 index, the main US benchmark index is massive, and that one company accounts for 6.7% of that is pretty amazing. But that is the reality. In fact, the top 10 holdings within an S&P 500 tracker range from that 6.7% down to about 1.6%. So they're quite big holdings of those of the biggest companies.
Yeah. So, we can ask more generally, where does passive investing lead you in terms of your investing? What sort of investing style does it lead to? What types of companies does it lead to?
Yeah. So, inevitably, from what we've just been discussing, it leads you to a weighting towards the biggest companies within an index. Now, in recent years, that means a weighting towards companies which have what's called a growth investment style. That's been the predominant investment style. These are companies which have high growth rates, are quite highly valued in many cases. There may be a sector bias. In fact, there is a sector bias because many of those big growth companies are to be found in the technology sectors. So we've got companies like Apple and Nvidia and Alphabet, the Google owner, sitting at the top of that S&P 500 index. So in recent years, it's tended to lead you towards growth and technology and big companies.
And let's dwell on this because this is really interesting. Almost it's become synonymous that big companies means growth companies because that's what it's been like for a long, long time. Passive investing definitely leads you to the biggest companies, but you said right now that means growth. I guess there could be scenarios, couldn't there, where a different type of company is the biggest or among the biggest in the index?
Yes, it hasn't always been the case that those kinds of big growth technology companies have led the way. I mean, if you go back 20 or 30 years, then companies like the biggest American company was ExxonMobil, a big oil company. Now that was a big company, but it wasn't a rapidly growing company.
No, cyclical in its performance.
Yeah. And just a completely different type of company, a slower growth company paying a high dividend yield, what we call a value company.
Yeah.
I mean, passive investing has lent towards this growth style in recent years, but it hasn't always been that.
Yeah. So what the fairest thing to say, I guess, is then that passive investing leads you to a predominant style, whatever that might be. I remember like for a long time in the UK, kind of still is the case. But it was these big kind of very, very reliable dividend payers that were the biggest companies, and they still are very big.
Yes, if you look at the constituents of the FTSE 100, they're very different from the constituents of the S&P 500, and in terms of style and sector. So the banks are very important, the pharmaceuticals companies are very important, and the energy companies are very important, Shell and BP, and that's a completely different type of index from the American index. So if you are investing passively to get exposure to different countries' stock markets, it's important to realize what you're buying. You are getting a very different type of exposure.
And so why do people do this, Tom? What are the pros of investing passively?
Well, the main advantage of investing passively is that it's relatively cheap. For the reasons that we said at the outset. You're not paying someone, a relatively expensive, highly skilled person to make decisions for you. You're simply doing something which, frankly, a computer can do, and a computer does do. And so you can do that relatively cheaply. Tracker funds would typically charge a fee of, I don't know, between 0.1 and 0.25% a year, which is a relatively low fee.
And you say a computer could do it, but it's. I mean, computers are very clever. That's the first thing to say. But it's also true that this by buying the index in this market cap weighting, the logic presumably is that, look, the market, in the collective wisdom of the market, has made a decision about what should be the biggest companies and the smallest companies. Yeah. What are the most successful businesses, the most valuable businesses? So you're already tapping into a kind of hive mind.
Yep.
That's sort of stipulated that the index should be shaped this way. And you're actually buying that. And so actually you're buying something very wise when you buy passively.
Well, what you're buying is momentum. You're buying the most successful companies. So you're buying, a higher weighting towards the companies which have risen to the top of the pile, if you like. Now, that can make sense, and certainly in a rising market, that can make sense. It's counter to the sort of contrarian approach to investing, which is that you should buy things when they're cheap, and benefit from the rebound or the reversion to the mean of those valuations. So you can make a case, you can make an argument for the capitalization weighted approach, but you can also make quite a strong case against it.
We're going to come on to some of that. Presumably, advocates of passive investing, of which Fidelity has very, very large passive index funds, but also lots of active funds as well. So, we're sort of a foot in both camps from that point of view. Advocates of purely passive investing will say that actually it's got a very good record of beating active investments. That's quite a deep rabbit hole to go down.
Yeah.
But at a surface level, what do people need to know when they're kind of looking at it from a performance point of view?
Well, I think the track record is informed by the fact that the market has been rising for quite a long time, and I think in a relatively steadily rising market, then especially a market that is so dominated by a small handful of companies, it is quite difficult for active fund managers to keep up with the passive index. Now, that's not the case at turning points in the market, because at a turning point, if the market has risen for a long time and then turns down or goes sideways for a while, then the shares which have done well and have risen to the top, and which as a passive investor you're going to be heavily exposed to, may not be the ones that lead the market in the when the direction changes. So at moments like those, a lot of people will be tempted by the passive investments because they've done so well in the recent past.
Yeah.
But it might be actually just the right time to adopt a more active approach to stock selection.
Yeah, and a lot of the arguments around active and passive are underpinned by statistics that you can read. People will find these about the number or the lack of active funds that have managed to beat their benchmark. They're worthwhile. I don't want to sort of undermine them or minimize those sort of claims. I think they're perfectly robust, but context is important as well. There'll be a lot of active funds out there which maybe because they have very high charges are always going to struggle to beat a benchmark, because you've got to take 1.5, sometimes 2 for sort of very expensive funds. You've got to take that off the performance. So surprise, surprise, they're going to underperform. Now, that's regrettable that those funds are out there. You don't have to buy them, of course. You can go for more competitively priced funds. It's a bit like saying there's lots of bank accounts that don't pay the Bank of England rate. It's like, sure, there aren't. There's lots that the bank would prefer not to pay you that and charge you in a way that is better for them. So there's a lot of kind of sort of dead weight in that active world, really, from an investor's point of view.
And you can completely disregard it. You don't need to invest in those funds.
Exactly. And then the other thing to say is what you've said, which is that, certain circumstances when the best companies grow to be the biggest and they continue to do the best year after year after year, well, guess what? Any active position is probably going to underweight those rather than overweight them. And so it's likely that you're not going to do as well.
Well, they almost certainly are when you find yourself in a situation, which is where we are currently, where the top 10 holdings in an index like the S&P 500 account for about 30% of the total value. Now, no active or few active managers are likely or maybe are even able to, because of the parameters within which they're forced to invest, able to match those allocations to those biggest companies. So almost by definition, they're going to be underweight those. And if those are the companies which are leading the market, then they're going to underperform.
Yeah, and the next question, we've kind of answered it. I was going to ask, what are the cons of investing passively? It's that concentration of risk, potentially, that's the downside.
Yeah, I think it's the concentration of the risk, and it's what happens at turning points. I always sort of remember back to the top of the dot-com bubble 25 years ago, when a passive fund in the UK, for example, would have been very heavily weighted towards a stock like Vodafone, for example. Now, as the dot-com bust played out. Thank you. As it played out, then those highly valued stocks were the biggest underperformers, and it was the out of favor, dull value stocks which did well. But you wouldn't have had an exposure to those because of the weighting of the passive fund. Yeah,
indeed. And also, just finally before we move on, lots of people will invest passively. They will see the sense in that. Look at the underperformance of active. Very often it seems very sensible, but value investing is very sensible as well. Sometimes the sort of very sensible principles in investing can be at sort of loggerheads, can't they? And that's one of them. It's like, yes, I invest passively, that's my principle, but do you always invest in very expensive things that are very highly valued? It's you've got to kind of choose your principles sometimes.
Yeah, and you've also got to be flexible. I mean, and also you have to accept that if you do stick to your principles, there might be long periods of time when your principle is out of favor.
Yes. Okay. Well, I teased at the start, Tom, that some people might be doing passive investing wrong. What other ways are out there, Tom, for people to invest passively? And before we get into the answer, I was talking to a colleague of ours just this morning about this. And they said they remember research which said that basically, I can't remember exactly, so I won't quote it, but they looked at many different ways that you could possibly rank companies beyond market capitalization. So, the dividend yield or the sales or anything. And they said, actually, market cap is one of the worst ways to do it historically. I mean, you probably have to run the numbers and how you're going to slice your numbers and statistics, whatever. But it doesn't have to be this way, does it? With passive investing?
No, that's right. I mean, that's an interesting way of framing it, because I mean, if you were, if you went to a market stall in the town and you went to buy the fruit and vegetables and you said, please, can I buy the most expensive fruit and vegetables that you've got?
Yeah, I'll buy more of those than anything else, please.
Yeah. I mean, that's not how you operate. That's not how you shop, is it? And, but when it comes to investing, that's kind of how you're doing it. If you take a capitalization weighted approach to investing. So one of the simplest ways of slicing and dicing is to just disregard the size completely and to say, look, there are 500 shares in this index. I'm just going to buy them all. I'm going to put the same amount of money in each. The maths is that you would end up putting 0.2% of your holdings in each of those 500 companies. And the word for that, the jargon for that, is it's not a capitalization weighted index, it's an equal weighted index. This approach has gained in popularity recently for some of the reasons that we've been talking about, which is that people are becoming increasingly nervous about the high valuations of those big, most popular stocks within the capitalization weighted indices, and they're looking for ways which might bias them more towards the cheaper, hopefully better value companies within the index. And a very simple way of doing that is this equal weighted approach. Yeah.
And if you're going to invest equal weighted, you're going to get more value versus, you're going to get value versus cyclical growth, value versus growth. You're also going to get more small versus large. Those are both two quite attractive things potentially in investments, buying things at a lower value. Smaller companies traditionally have had more of their growing ahead of them, and that can be a good place to be. So there's kind of a sound logic to it, isn't there? But presumably, is there increased risk? What's the effect on performance?
Well, there can be at different times. I mean, you're right. The logic is sound over the long run. Small companies, have, the old saying is elephants don't gallop. Small companies have more room to grow. Value, they're less highly rated than the bigger companies often. The logic is there. It doesn't always work, and actually, the last 6 months or so has been a very good example of that. That within the US, smaller companies have actually, in this environment that we find ourselves in of, tariffs and trade wars, and smaller companies, which you might have expected to do quite well, have actually done quite poorly compared to those large companies. And we've seen a big bounce back in the market. And of course, the big companies have led that big bounce back. So, so often the long-term logic doesn't play out in the short term. It doesn't mean that it's wrong. It just means that in the short term, it's not working for you.
And look, if there was some hard and fast rule as to one way always working over another, everyone would do that, and the point is it all swings between the two very often. So before we let this go, how can people actually do this, Tom? What options are out there in terms of these passive equal weighted options?
Yes. Well, I mean, there are a couple of ways that you can do it very simply. One is an ETF, an exchange traded fund,
Yes.
and one is a traditional unit trust. They're both available on the Fidelity platform. One of them actually has just recently been added to our Select 50 list of preferred funds, and that is the Legal and General S&P 500 US equal weighted index fund.
Mm-hmm.
It's a long name, but it says it all. That's the traditional unit trust mutual fund. Then iShares also have an exchange traded fund, the iShares S&P 500 equal weighted ETF. So both of them, I mean, they will be very similar. They'll be very similar in their makeup. Naturally,
they're equally weighted.
They're equally weighted,
and
they're both tracking the same index. So.
Yeah, and would you, if you were going to use one of these things, I mean, it's always wise not to sort of make very big wholesale changes. I mean, are they something to introduce at the margins, or a sort of significant minority of your US exposure? Is that the way to? Is a sense in having that alongside something more traditional?
Yes, well, I that's exactly how I would do it. I mean, on the basis that you don't know whether these big tech stocks are going to continue to perform. There's a reason why they're big and popular.
Yeah,
is because they're high growth companies. They may well continue to be strong performers. So I think there's an argument for having a bit of both. If you want to have a passive exposure to the US market, then I would say not a bad way to do it is to have, some of your money, maybe half your money in the equal weighted index and half your money in the capitalization weighted index. The fact is we don't know.
You don't know what's going to do best. Yeah. But, and that equal weighted way of doing it, to my mind, you're sort of, that's a good way to show optimism in the US economy a bit more generally, right? Because these are big companies. We should say they're not small companies. Just because the 500th biggest company in the US is a big company, isn't it? Yep. By many people's standards. But you'll probably have a bit more domestic sales versus the very largest companies. Probably a bit more dependent on what the American economy is going to do. Still a growing economy. It's got its headwinds. But
and what you'll get is a very broad-based exposure.
Yes.
Because, the S&P 500 will cover, a wide range of sectors. It will cover industrials, consumer stocks, technology stocks, energy. I mean, the whole waterfront. And you're not basically making a bet on one or other of those sectors doing better than another. You're just getting that broad-based exposure.
Okay, well, Tom, I think that just about covers it. Before we go, I'm going to urge everybody watching and listening to this that if you found any of it useful or interesting, please do hit the like button or maybe even subscribe or share or leave a review. It's going to help more people find this content. So that said, Tom, that is it for now. Thanks for joining me.
Thanks, Ed.